Very good afternoon. On behalf of the Center for Corporate Governance and Sustainability Research at IIMA Ahmedabad, we welcome you to this webinar. It's a pleasure to have Ms. Anjali Bansal today with us, who is going to talk about advancing climate action through climate tech innovation. Before I hand over to Ms. Bansal, it's my pleasure to introduce her. Ms. Bansal is the founding partner of Avaana Climate and Sustainability Fund, investing in technology and innovation-led startups, catalyzing climate solutions and sustainability. Previously, Ms. Bansal was the non-executive chairperson of Dena Bank, appointed by the Government of India to steer the stressed banks resolution and merger with Bank of Baroda. Prior to that, Ms. Bansal was a global partner and managing director with TPG Growth PE, responsible for India, Southeast Asia, Africa, and Middle East, and also strategic consultant with McKinsey in New York. Ms. Bansal has invested in various successful startups, including Nika, Delivery, Urban Company, Darwin Box, Pharma, and few climate tech leaders. She serves as an independent director on leading boards, including Tata Power, Nestle, and Piramal Enterprises. She has also been appointed on the board of ONDC, Gift City, and she also chairs the Climate Council with IBCA. She is a member of the Evaluation Review Committee for Niti Aayog, India's premier policy think tank, chaired by the Honorable Prime Minister. She previously chaired the India Board of Women's World Banking and served on the boards of GSK Pharma, Siemens, and Bata. She co-founded and chaired the FICCI program for women on corporate boards. She is a member of the YPO and a charter member of TIE. She has been listed as one of the most powerful women by India's leading publications, Business Today, Fortune India, and Forbes India. Ms. Bansal, we are very happy to host you here for this webinar, and we hope for a very interesting webinar. And I welcome you and hand it over to you.
Thank you so much, Professor Neerav. Good afternoon and namaskar to everybody on the webinar today. It is always a pleasure to be in and with IIM Ahmedabad. And thank you also to Professor Anish and their teams. Being an Ahmedabadi myself, I grew up in Ahmedabad. I feel whenever, even if one is virtually with IIM Ahmedabad, one is a little bit home. So delighted to be here. My charter and mandate given to me today is to share some of our thinking around why is it interesting and important to invest behind innovation and technology for climate solutions. Where are the opportunities? Where are some of the gaps? And how can we all collaborate to get to some large-scale solutions and impact outcomes in this space? So with your permission, I will go into a screen share. We will run through a few slides, and then very quickly thereafter, we'll move into discussion mode. I think the Q&A window is open, so I will also urge all participants to please post your questions and comments, and our professors Neerav and Anish will also curate and point me, and if you need to direct me in a certain way while we are speaking, please do so. So let me talk a little bit about capital for climate. What does it mean and why is it interesting? So having been around for more than 30 years in business, I've seen the whole journey of digitalization. 30 years ago, there was no digital per se. There was barely enterprise technology. And today, digitalization is embedded across the board in every enterprise, in every element of how we live, how we work, how we interact and play with each other. So in our view, sustainability really is the next digital. Given where we are today in terms of having a viable planet, business continuity, societal continuity, it is the next big digital. Every element of our life will have to undergo a fairly transformational change to have that sustainability embedded. India itself is a very big opportunity. We are sitting, in entering our Amrit Kal, as our Honorable Prime Minister says, 25 years away from our 100th centennial anniversary of our independence on a massive growth path. And so India's growth plus the need to have climate action together, it's kind of a big opportunity at the right time for all of us here in India. We do not have to trade off between people, profits, and planet, right? We actually have to accomplish all of it together. We will have to accomplish 6 to 9% GDP growth year on year for the next 20, 25 years so that we get our 200 million people out of poverty. We are the largest, most populous country in the world. We are the youngest country in the world. Consequently, a lot of work and livelihood has to be found for our young people as well. Despite all of that, we are actually still very, very low on our overall fossil fuel consumption as well as carbon footprint. And hence, in a particularly heightened sensitivity around carbon footprinting, India has really contributed less than sort of 4% of the cumulative carbon emissions till date. And yet we will disproportionately contribute. We're today the third largest emitter in the world. Over a period of time, the other two being the US and China, over a period of time, India will actually become a larger emitter before our emissions decline. And consequently, we need to find those new solutions that allow us to achieve this growth across the board, across industry, across our economy, while maintaining sustainability. We are excited because, India, we do have a history and a track record of both frugal innovation as well as leapfrogging. So we have leapfrogged from a cash economy to now a digital payments economy. We actually completely bypassed the debit card, credit card piece. We've also bypassed the fixed line scale up and went straight to 4G and now 5G. We are the lowest cost digital data network in the world today. And consequently, 700 million smartphones that are available to the length and breadth of India. So in that sense, we have a ability to, and coming out of Ahmedabad, I would say that ISRO has demonstrated how to do frugal space tech even. So I'm sure we will find solutions in India that take us to frugal solutions for climate. What does climate mean? The path to net zero is across the dimensions of mitigation, which is reducing emissions for global warming, adaptation, responding and adjusting to climate impact, or transitioning from a high carbon economy to a low carbon economy, and building resilience. So climate proofing our economic and social systems. And these three are very, very important. I think a lot of the global north that has already been through its development journey, you'll hear more about carbon and emissions in the global north, whereas for those of us living in developing countries in the global south, adaptation and resilience are equally important. So adaptation, as I mentioned earlier, is creating climate resistance in our inputs and processes, waste reduction, water management, and transition financing. Today, there is a big gap, and I will talk about some of the gaps in financing. And resilience is important because we have one of the most vulnerable populations in the world. So when we look at the immediate impact of extreme climatic occurrences and conditions, so extreme heat, for example, in India, 52 degrees Celsius, people cannot work. Our day laborers and farms are unable to work. Our standing crops with erratic monsoon, erratic water, flooding get destroyed. So we actually have to create much more resilience in our energy system, in our agricultural system for both life and livelihood. When we look at Avaana, and we are India's first thematic focused fund on climate and sustainability that is centered in India, for India, and across the global south, we think about climate really as a lens. So the mitigation, adaptation, resilience lens as it applies to the largest emitting industrial sectors. So the sectors underlying climate, 90% of our emissions come from energy and resource management, mobility and supply chains, and sustainable agriculture and food systems. Each of these also interlinks significantly with each other. So water and the water economy, availability of water, use of water, and discharge of water is embedded across the board. Circular economy and finding new generation alternative materials, whether it is for new battery chemistries or it is in the supply chain, so new packaging, or frankly, even in agriculture, when we look at resilient and sustainable agricultural practices, as well as a substitute for very harmful chemicals and fertilizers, which we need fertilizers, but what is a good substitute for the harmful chemical fertilizers? On the energy transition side, having energy access, microgrid, off-grid, battery storage, particularly, in India, we are blessed in some ways because we have 300 days of sunshine. So availability of renewable is not a challenge. What is a challenge is accessibility to everybody. And each of these, the solution areas that we look at, they actually have to be frugal and cost effective to address the economic needs in India. So something that is developed, say, in Germany or North America or somewhere in Europe may be a perfectly fine solution, but it may be too expensive for India. So ultimately, what works is adoption at scale. And for adoption at scale, you need market readiness as well as commercial readiness. Or just having a smart engineering product is not enough. And consequently, here we have seen again and again that takeoff really happens when there is limited dependence on, say, government subsidies or incentives, but the market is ready. So we saw that in renewables. 15, 20 years ago, our unit cost of, say, solar energy was 5 times what it is today, heavily subsidy dependent. Today, on the other hand, a new unit of renewables, and today we are doing hybrid and round the clock, a new unit of renewable is actually cheaper than a new unit of thermal. So it makes business sense to adopt this. We need similar solutions in things like plastic alternatives, as well as food systems. Where are the challenges and the gaps? So we see these numbers. We need about 50 billion of patient capital over 5 years. Today, what is coming in is about roughly about 10. And consequently, that's a huge gap. So we have 10, we need another 40. The challenges for climate tech are, the playbook here is very different from your traditional startup ecosystem. So while India is a very, very robust and a thriving startup ecosystem, we are the third largest startup ecosystem in the world, more than 1 lakh registered startups with DPIIT. Our last 2 decades have been focused on internet, consumer internet, e-commerce, fintech, none of which require significant capex. Whereas the technologies that we talk about for climate are largely industrial, they are B2B, as well as need a lot of capital that will go in for, say, manufacturing or for getting to market. Where we are today, if you look at sort of the science behind it all, there is a lot of capital available when the company is going to growth stage. There is some capital available between ideation in a lab and what is called TRL level 3, so technology readiness level 3. The gap between TRL 3 and TRL 6 is really where there is a desert today. Very little capital available. Early stage capital is also not available. And we will talk about that in a bit in more detail as we go through this discussion. What is required? We do require a coming together of the ecosystem to make it all work together. So we need the early stage technologies that are coming out of universities, laboratories, R&D, and innovators, even private innovators, to provide new solutions, new innovation. We need the industry linkage. Because as I mentioned earlier, the adoption of these technologies will happen in large companies at scale. So if it is water, then the treatment of effluent water. If it is circular economy, then the recovery of waste materials, the recycling of waste materials, and eventual come back into the input side. Industrial decarbonization, carbon capture, renewable energy, alternative materials, all of that will happen in large corporates. So we need strong industry linkage. Third element of this is policy support. In India, we've been fortunate. We've had a lot of enabling policy historically over the last sort of 5, 8, 10 years on climate. So whether it is PLI now for solar manufacturing or FAME 1, FAME 2, which supported the growth of EV. The recent budget announced the critical minerals mission. The last budget also announced capital and support, both in terms of incentives as well as sometimes industry regulation is helpful to create markets, right? So before EPR, the extended producer responsibility, there really wasn't a recycling market. Today, there is a recycling market. So enabling policy, and finally, catalytic capital. Capital, we need all types of capital. You need the very patient capital that I mentioned earlier that can support the growth of new technologies and R&D. That could come from philanthropy, both corporate as well as individual philanthropy, government grants. And here again, from the government, BIRAC, METI, DST, they do a lot of grant support. But beyond that, you need equity for enterprise creation. Then you need growth capital, equity and debt. And that debt piece is also more or less missing in our ecosystem today. So there's a lot of white spaces where, yes, of course, it's a problem, but the flip side of a problem is an opportunity. A little bit about how we work. So at Avaana, we actually bring together these four ecosystems through the various things we do. We engage actively with the startup ecosystem. We engage and link up with industry through our various boards, through the chambers of commerce, as well as running multiple corporate programs. We run something called the Grand Challenge for Climate Tech Innovation, where we involve a lot of corporates. We work closely with policy across some of the universities, the research bodies like RMI, as well as Niti Aayog, and then across the catalytic capital ecosystem as well. I'm going to talk a bit about some of the interesting opportunities that we have seen and invested in, and we see about 1,000 new opportunities every year. And so when I speak about these four are part of our portfolio, but for every investment we make, there are at least 20 others that are really, really good. So I want to make sure that we have a message here that shows that there is a lot of activity happening in this space. I will encourage any founders or potential founders who are listening into this webinar to think about building new and building large. Scale is important. And I might even say scale is critical. Scale is critical to deliver impact, and scale is critical to deliver returns. I'll speak about four of our companies. They are across food systems, energy transition, mobility, and carbon management. Iki is this is the first one on your top left. Iki Foods is, in some ways, it's really the future of food production, not just for India, but for the world. And by the way, a lot of our companies, and we are seeing this now again and again, we'll find innovation and frugal technology emerging from India. But if you can solve for 1.4 billion Indians with our diverse requirements, complex market, and extreme cost sensitivity, if we can solve for India, we can really solve for the global south and perhaps for the world itself. So Iki is a great example of that. They have built polymer-based, patented growing chamber systems where they're able to maintain stable root environment. So it's not a greenhouse. They don't maintain growth environment for the full plant, but really for the root system. They're doing this in Kota, 50 degrees Celsius ambient temperature, right? It's very, very hot in Kota, and they're able to maintain a constant, much lower root temperature that allows the root to survive. They've disaggregated the growing process, and these are two mechanical engineers from IIT Bombay, so they've disaggregated the growing process really into, think about it like assembly line manufacturing for plants. 80% less water usage, marginal electricity because there's no greenhouse, there's no not much cooling requirement. They use evaporative cooling, and consequently 3 to 4 times the yield per acre that you would get in traditional farming. Hugely scalable at industrial scale, and it actually does look like a factory shed. It does not require agricultural land, so it is not displacing farmers. In fact, it generates additional employment. They've also, the low water usage is because they have embedded sensors in the growing system, where they're doing continuous monitoring and IoT and AI-based analytics so that they're able to do precision delivery of nutrients to the root systems. So they're growing things like tomatoes and eggplants, cucumber, green chili, really Bharat ki sabzi at everyday prices, but 3 to 4 times yield per acre and 80% less water usage. So very, very innovative and really the future of food production, not just for India, but around the world. Kazam is one of our companies in the mobility space. And when you think about electric mobility, one of the key bottlenecks for scaling up and adoption is what's called range anxiety, right? Charging infrastructure. And the physical infrastructure is getting installed by a lot of the discoms, the electric utilities, the Tata Powers of the world, as well as the gas station operators, the HPCL, BPCL, Reliance, and so on. However, for every physical charging station, there is a requirement to really work the asset and maximize utilization to make sure that there is availability for the vehicle operator and the fleet operator. So Kazam has built the interoperability software layer on top of that can ride on top of all charging infrastructure. So it is agnostic to hardware. They are now linked up and integrated with some of the largest OEM platforms. So they are integrated with the hardware of the vehicle. They are interoperable across charge point operators. So it doesn't matter who owns the charging point. You can use a Kazam software for that, and with fleet operators. So they now have more than 15,000 charging points. They're on track to scaling up to about 60,000. Have already expanded beyond India. So they got invited into Malaysia working with Petronas and really accelerating EV usage. So very, very innovative company. Think it is like the Android layer for mobile phones. So it doesn't matter what phone you have, could be a Google, could be a Samsung, it will run an Android. So Kazam is like that. I'll go to Aram. Aram in solar energy, and many of us, I'm sure, will be familiar with the recent PM Surya Ghar Yojana, where India has a tremendous opportunity for creating energy security by using solar. However, solar so far has been limited to either utility scale or for large commercial and industrial uses. Rooftop has not fully taken off for multiple reasons. One is cost effectiveness, availability of good installers. There is a payback period that residential and small business owners are somewhat reluctant to undertake that risk. So Aram has stepped in and they've created a full stack technology software plus hardware based solution where they function as the discovery marketplace for installers. They enable installers to find customers for rooftop owners. They have a full-fledged procurement marketplace, as well as a proprietary real-time sensor-based monitoring system called AROC that creates assurance and financing linkage and brings down the total cost of ownership. So it reduces payback period, makes it much more accessible and affordable, and creates better outcomes for everybody in the ecosystem. So the small installer, the MSME rooftop owner, as well as the financier of the rooftop itself. Finally, I'll speak about Centra. Centra is a very, very interesting company in carbon management. They are a SaaS platform to track, reduce, and report basically scope 3 mitigation and management for hard to abate industries like steel and cement. So they embed in the manufacturing process for steel, cement, and other such heavy industries. A lot of the world's scope 3 today actually sits in our part of the world. So across the Middle East, India, Southeast Asia, China, because so much manufacturing has got outsourced here. Also for India in particular, 80% of our infrastructure is yet to be built. That is in the plan for the next 25 years. So we will use more steel, more cement. And there is an increasing push around the world by both regulator as well as capital providers to do much more reliable measurement and reporting. So scope 1, scope 2 is easier, scope 3 is much harder, and that is what Centra is solving for. So I'm going to pause here, perhaps share with you a little bit of a landscape on some of the other things we are doing, and then I will turn it over for questions. I had mentioned earlier how we need to have a ecosystem collaborative approach to solving the problem of climate as well as investments. And here at Avaana, we have built very strong partnerships with government, think tanks, and industry bodies. We ran the largest climate conclave with the MOEFCC earlier this year, the Ministry of Environment, Forest, and Climate Change. We have also launched the first Climate Tech Startup Challenge Award with the government, with Startup India, as well as with the Atal Innovation Mission. We run a series of Let's Talk Climate fireside chats, podcasts, mixers. We are launching the India Climate Week, which we held last year. We are launching our second edition this year across Mumbai, Delhi, and Bangalore. For folks who are interested in joining any of our events, you can see them on our LinkedIn. And we have been very fortunate to get the support of very, very reputed financing partners like the Green Climate Fund. We are the first fund in India to be supported directly by the Green Climate Fund. So once again, thank you, and I look forward to any comments and questions and discussion here.
Thank you, Ms. Bansal. I invite participants to please ask questions. You can either do through the Q&A tab at the bottom. You can also raise your hand and ask the question. Right. So both options are available. In the meantime, well, Bansal, let me ask you the first question here. And given my background in financial analysis, the first thing which came to my mind is that in any startup, we look at how interesting the idea is, whether it would be financially viable at some point of time. When you analyze these climate tech startups, do you also have a threshold on how much should be the environmental benefits, or it's just having that is enough?
Great question, Professor Neerav. So we look at the five criteria. The first one, which is a absolute gate, there has to be a measurable, demonstrable, positive solution on adaptation or resilience. Um, all of us in this space know resilience is harder to measure and so on, but I think for us in India, resilience is very important. So if a company, regardless of how exciting and cool the new technology is and how attractive the business is, if it is not solving for mitigation or adaptation, which means it is core not solving for climate, it is not an investment for Avaana. So our Avaana Climate and Sustainability Fund, our first lens, and it is a absolutely binary lens, is it solving or not solving? Given that we are early stage investors, so we go in quite early, pre-series A, series A, companies are very small startups um, on the cusp of scaling and commercialization. We take a fairly medium to long term view on the overall climate impact. So immediate numbers are small, the additionality of it is significant. So that's how we look at the scale of impact. And then, of course, we look at how novel or innovative is the technology. Is there a moat? Is it replicable? How easy is it to replicate? Second is what's the business model? Because, like I said, a cool technology will not create returns. There has to be a scalable, commercially scalable business model. Third is what's the quality of team? And is this a team that can actually build this business? And sometimes you have fantastic sort of engineers, but you do need to build a business. So can the team build a business? Is there complementarity? And in early stage teams, we know the business model will evolve. So we also look for learning agility in our teams. Can they be agile and evolve as the market evolves? And finally, of course, we look at can you get returns, financial returns, because this is commercial capital that we are investing. So that's what we look at.
Thank you. So I think it's Professor Sugatan. Yeah, please go ahead.
Thank you, Anjali. That was a really concise but I guess impactful overview of the landscape. I have a very quick questions. From the center as well as a researcher, I've been tracking this sector for quite some time, at least the past 1 decade. What we have seen is this, waning and waxing of interest, waning and waxing of policy landscape, and the emergence of new players, and also fly-by-night operators. You yourself have been in this space for quite some time. If you could throw some light into your early journey when Avaana started, what were the biggest doubts in your mind, doubts in the ecosystem, and what has changed since the last 5 years or 10 years, let's say?
So let me actually rewind even further back. So the first cycle of clean tech 1.0, was a very optimistic, hopeful period, 15, 18 years ago when the first solar investments were made and so on. And globally, a lot of capital went into this space. Unfortunately, it saw very little commercial return. And I would say it's probably because of two, three big reasons. And those are the reasons that have changed. One is the technology itself was high cost. So we had yet to evolve the technology to get to a point where it is cheap. Like today, sensors are so cheap, you can put them into small farms. You can put it into the pipes at Iki. 15 years ago, that was not the case. So that Moore's law application, we have now seen in climate, and it has taken us 10, 15, 20 years to get there. So the technology was not cost effective, and consequently, it required a lot of subsidy support, philanthropic support. So business models were not commercially viable on a standalone basis. And third, I would say very importantly, actually, I don't think we had market readiness. So it was something that people were doing to save the planet, not to save their business. And hence I keep going back to, it is only going to work when we come up with solutions that are commercially viable. So there has to be at least cost parity, if not lower cost. So, renewable is lower cost than thermal today. So it's a no-brainer. Companies are not putting up solar because it is necessarily good for the planet or they have net zero commitments, but because it is actually more sensible for the business. So I think that's one of that whole interaction and forces at work that has shifted a lot. We have cheaper technology, we have tremendous demand from market impact. And it's not the consumers. Consumers, particularly in India and so on, do not have the surplus. They don't want to pay more. So but at the same time, companies have made net zero commitments. We have both carrot and stick policy. So EPR in some ways, I would say, is a stick policy, the extended producer responsibility, but it has created a new market for recycling. Enabling policies like PLI are bringing capex and manufacturing into a space where otherwise we would have dependence on foreign supply chain. So I think market readiness is there. Capital does wax and wane a little bit, hot and cold. So, there used to be a lot of focus on ESG, and then everyone, I think we have all realized it's very hard, if not impossible, to actually measure ESG. So that is seeing a decline now. But I think it is a good thing, because instead of ESG, if we actually could come up, which is being developed, much more robust, measurable, and objective metrics around whether it is climate impact on mitigation or around adaptation, or frankly, even around resilience, and having that just transition, then I think we might actually come up with more robust metrics, real measurements, and the right trade-offs, because just having measurement doesn't mean that you have to do what maximizes the measurement. Sometimes you have to make the right trade-offs as well. So better frameworks. So I'll pause there. I think that is what has changed. And yet we've had to do a lot of education. So when we started out on our journey, it was initially, okay, is this ESG? Is it CSR?
CSR, right.
Yeah, right. So we said, no, this is not CSR. This is actually, it's like technology venture investing. It just happens to not be crypto or not be fintech. It's in climate. And this is deep tech. So good news is founders are catching on, capital systems are catching on. We have a lot more capital coming in at the late stage, not enough today in the early to growth stage.
The early stage, the first, at least in India, came from the investor side, right? Larry Fink and Blackstones of the world, where the commitments which were made by the pension funds in the global north started sort of, becoming investor imperatives, let's say, in the global south. That, I guess, is changing. Because you are a recipient, you directly interact with these providers of capital. Has that changed?
No, a lot. It has changed. I'd say mostly in a very productive, constructive way. So I think Larry Fink said that the next 1,000 unicorns will be in climate. When we started out on this journey, we actually experimented a little bit. We created a small seed pool. We invested in a few companies to see if it works. And then we went and raised third-party capital. I think the big impact has first been seen in the public markets. So there is a measurable positive or negative impact on cost of capital. So companies that have demonstrated better intent on greening, so whether it's renewable or it is manufacturing processes or on other sustainability, zero discharge, biodiversity, they are generally rewarded by foreign institutional as well as now domestic institutional investors and shareholders. So there is more demand for their equity and consequently lower cost of equity. Higher stock price, lower cost of capital. That said, we have seen some tempering in the last couple of years. some very large global corporates have been, I guess, penalized by shareholders for the view was they have gone overboard on sustainability and not delivered on business results. So I think the lesson here is there is no compromise on business results while going up the sustainability paradigm, which brings me straight back to we do need more cost-effective alternatives and solutions. I mean, corporates are not evil, right? We are not evil people. We are not using plastic because we want to be bad. It's really because there is no alternative. So I talk about this, but we have a company called Dharaksha Solutions. Dharaksha is based out of Delhi. They started with the problem of what to do with agri-bio waste, stubble burning, which as all of us know is very acute in Delhi. They all feel it. And then they realized that there is another use case. So they are using this inedible biomass as a substitute, have got a proprietary inoculant and a methodology in which they are able to put this into molds and create a substitute for thermocol or styrofoam. So styrofoam is 100% non-biodegradable. This is 100% biodegradable. And today, at this scale, they're about 2x the cost. The nearest company in the US, company called Ecovative, is 5 times the cost of styrofoam. So very limited commercial scalability. Whereas for companies like Dharaksha at scale, if they are 1.2, 1.3x the cost of styrofoam, then it is a real substitute.
Wonderful. I guess we have one question from the audience. Neerav, would you like to?
Yes. So first, I think let's hear from Mr. Rishabh Somani. Please go ahead and ask your question.
Hi, ma'am. Thank you for this session. It's very informative. I was working with the Greener Sustainability Accelerator based out of Mumbai. 100 or so startups in the sustainability space scale up. And one of the problems that I kept seeing is that, while some, maybe 5-10% of them have the potential to, reach what you're like, true industrial scale and become even unicorns, a lot of them which do like physical constraints or market saturation, or business model fit, like, they are unable to move out of the small to medium enterprise stage into larger scale. So for them, there's, do you see other viable alternatives to sustain the business or, market linkages or, public policy interventions and effective?
So Rishabh, the answer is because when you are building a startup, it is all of the above. So the playbook for deep tech, hard tech is not established yet. It's not doing SaaS or doing fintech, for which now we've got 2 decades of history in India. And when I remember when we started doing the first round of early stage investments in early 2000 in India, the world did not believe in India. Maybe you guys can do IT services. Okay, maybe you can do consumer internet. Nobody believed we could do fintech. Like, how could India innovate on finance, right? And today we have UPI and ONDC and probably the most effective, efficient fintech ecosystem in the world. And then same thing happened with SaaS. So I think that is a journey we have to go through now with deep tech. I was in Madras last week in Chennai and I visited Agnikul. And I had goosebumps when I saw that single piece printed engine, first of its kind anywhere in the world. And it's happened here in India. It takes time. It takes a lot of people to believe in it. There has to be a lot more hustle. Founders do have to work a little bit harder. Early stage investors like us also have to work a little bit harder with them to get to the industry linkages, to find them debt. Because I think that working capital product doesn't exist in our banking system right now. So we are working actively with a number of NBFCs, SIDBI, government, to see if we can bring in that kind of either concessional finance or working capital loan products that can be made available to these companies. Because it's not going to be a straight path from Series A, Series B, Series C equity raising. It will take longer for them to get to full-scale commercial viability. And to your point, Rishabh, sometimes they won't.
Thank you, ma'am.
The next question is by Mr. Divyendu Sharma. I'm going to read it. He wants to know about your experience in terms of the support from government, incubators in educational institutions, private accelerators in supporting the climate tech ventures at various stages, and also your experience in terms of partnering with large players when you funded new ventures.
So let me break it up. There is increasing activity in the commercial side of early stage. So a number of new incubators, accelerators. When we started, we were really the only organized investor of scale. Today, almost every generalist VC also has a climate strategy. Right? So they're all saying 10-15% of our portfolio will go into climate. So, and we welcome all of that because you do need that additional the capital to come in. So one is that. Second is from the government side, I think a lot of the Atal incubation centers, DPIIT runs a scheme called the Startup India Seed Fund Scheme, through which they support about 250, close to 300 now incubators across the country. And climate country, I'm increasingly seeing climate as a theme and deep tech as a theme there. Third piece is collaborating more closely with corporates. Now, here is a challenge and an opportunity. The challenge is for a small startup to try and work directly with a large corporate with the best of intent. And a lot of large corporates actually now have these innovation teams and so on. But it's a little bit like an elephant trying to dance with a mouse. So it's very hard. It's not fun for either. It's a long cycle. The young startups don't really have access. So we put together a lot of coalitions around this. So for our portfolio, of course, because we are very well connected into the corporate ecosystem. So we do early go-to-market. We do a lot of piloting, sandboxing. It helps us in our diligence. So it's much easier for us to kind of access a large company. And if somebody's doing work in, say, industrial automation, then you talk to a Siemens or a Tata or a Mahindra or in energy. For agriculture, you have a Unilever, ITC, Nestle, Godrej, and so on. And so, in some ways, this is the role that investors and advisors have to play in getting access to talent as well as access to market for these companies.
Thank you. Next question is by Mr. Devang Pandya. So he wants to know your thoughts on, he uses an abbreviation, CCUS, Technology Startups in India, and Sustainable Finance.
Right. CCUS, we are seeing a number of startups, but in the absence of a clear regulatory regime on CCUS, I think it will take some time. It is still nascent before we start seeing real commercial models grow. I think it's quite risky to base entire revenue model on carbon credits today, because we really don't know how that space will evolve. It's not positive, negative, it's just unknown. And unlike the West, and by the way, in the West even, SBTi earlier this year has taken carbon offset off of the list of permissible SBTi topics. And so there is, I think, divided opinion globally on the carbon offset regime itself. The second question has gone off the screen.
Yeah, that was about sustainable finance in
India. Yeah, sure. So sustainable finance will come again through three sources. There is a lot of philanthropic as well as grant capital that is now more and more capital that is becoming available. So some of the largest foundations today do have a climate thesis. It tends to be a little bit more sustainability focused, say biodiversity, nature-based solutions, or resilience building in communities. So if you are working in that space, I would urge you to look at foundations and corporate CSR and so on. On the other hand, there is, like us, there are others who are also providing equity capital. As I mentioned earlier, what is missing a little bit is the mid-stage growth stage credit and credit linkage debt financing. And then again, there's a lot of capital available in the organized sector, particularly for renewable brownfield, greenfield projects today in the commercial space. So, you have Brookfield and TPG and KKR and a lot of the large global players, including pension funds and infrastructure players who are, Temasek, CDPQ, CPPI, all of them are investing in this space.
Okay. So please feel free to ask questions if you have any. We'll wait. In the meantime, I'll ask a question. So in terms of the ESG related scandals, now, so when you do due diligence of a startup, do you plan well in advance that these things don't happen? For example, what if, and we have seen such cases where like the amount of emissions were understated, right? Or in some cases there can be, child labor violations, and I'm just thinking aloud. So, so how do you prepare yourself when you are evaluating a startup, or if you have seen any such violations, and how did you handle that?
So, given that we go in fairly early into these companies, at the time of our investment, they are not very large scale in terms of workforce or manufacturing footprint, but over time they grow. So, when we enter at the time of investment, we do baselining. So, the baselining is twofold. Again, because these are technologies that will, the impact of which will be seen by their adoption by others. So they will not be doing their own adoption. Their adoption will be by others, either large corporates or otherwise. We look at the footprint of the company itself, of the startup. And we build in very, very robust. So we have a very robust policy framework, both for investment selection as well as for post-investment monitoring. It's the ESMS framework. So it's built on the IFC IIMA. And we've actually built a custom framework with the GCF on the environment sustainability management systems, both pre and post investment. We have a development committee that screens every investment before it goes into our investment committee, before our IC. And we look at impact in 4 buckets. So there is the climate impact, which I mentioned, mitigation, adaptation, resilience. So that's the environmental impact. We look at economic impact, social impact, as well as inclusivity. So we are a 2x fund. So while gender is not a filter per se for investment decisions, we actually find that we see a lot of gender diversity in our both portfolio as well as pipeline. And then post investment, we have a full-time person on our team who works with our portfolio companies for measurement, reporting, and capacity building, because remember, these are young companies. So they do require capacity building, and we link them up with many of our large funders who run large capacity programs.
Okay, thank you. Next question is on
Sorry, Professor Neerav, I realize I didn't respond to your question around violations. I think violations will happen when there is poor intent. We have to go in with assuming good intent and then back that up with continuous monitoring. Our companies once they get to a certain stage, we encourage them to have internal audit, and then external audit is a requirement, both a governance requirement as well as an operational requirement.
Okay. So the next question is on suggestions on balancing between market readiness and anticipated inevitable policy response, plus climate technologies S-curve to reach maturity technology leapfrog.
I think, if I may, on a lighter note, say anybody who can anticipate an inevitable policy response, I'd like to talk to you, but fortunately we have a benign policy regime, so it is generally supportive. I think it is very brave to try and time when market will be ready and when policy will be ready. So you do have to keep a very close eye on what is developing, and I'll give a couple of examples. Sometimes policy actually creates markets, and I've given the example of EPR and recycling, but more recently there has also been the battery energy storage systems. The enabling regulation was always there, but the first market mechanism got set up and the first tender was passed last year in Delhi. Once that happened, it created a precedence and a framework, and now we are seeing, I think, almost 20 gigawatts of sort of BESS tenders out there, and they are embedded in round-the-clock hybrid tenders. So you're absolutely right. There is a balance, and that's the judgment you take, whether you may have technology readiness, but is the market ready? Sometimes the market is ready on its own because it is such an attractive solution. Sometimes the market needs a little bit of a policy support, and that then has to be, you can't be too much ahead of the curve to get there.
Okay. Rishabh, you have another question. Please go ahead.
Hi, ma'am, Rishabh here again. So dialing it back a little bit, and I had a question related to the fund accounting, because this is essentially a VC fund, right? And so are you guys still aiming for a 50-60% IRR, even though you have a longer exit horizon, or is it somewhat lower? And if you could give me a number also.
I will not give you a number. Those are not, that's not shareable information. But we look at IRR, actually, we look at returns both on IRR, MOIC basis. And we have very aligned capital with us, commercial funds. So we have very attractive returns. So I'm not sure what the question was. If you were looking for a number, I'm not going to provide.
No, I just generally is it a bit lower than traditional VC firms because of the horizon, or does it make up in the growth aspect of it?
It is the latter because you get large outcomes. It's not very different, actually.
Got it. Thank you.
In fact, maybe on this, I'll ask a related question, and rather, I'm not interested in the number, but in terms of the parameter do you use and whether it would differ from industry to industry, whether
Right.
you're using a multiple of invested capital or IRR or NPV, depending upon a
Right.
particular portfolio or an industry.
No, so actually for us, it is both IRR as well as MOIC, which is money on invested capital. We tend to not look at NPV as much, but IRRs run anywhere in our sort of mid 20s to 30s. In any case, the longer you hold, you will have a declining IRR. And I think MOIC underwriting always is, given that we go early and take risk, it is a very attractive underwriting.
Any more questions? Yes, Professor Sugatan, please go ahead. You are on mute.
No, since we are getting into the nuts and bolts, I just got curious about the capital structure. Because you see right from the inception onwards towards, let's say more maturity. What is a typical sort of, capital structure for, let's say, at the seed fund stage, given that it's a little different from, the usual, business models and the challenges are different. If you could, again, some broad idea, how does it evolve the capital
So
structure?
capital structure in the company or in the fund?
In the company, and how does the fund comes
right.
in,
So initially, it tends to be, if it is a repeat founder, they may bootstrap it with their own capital. But what we see most often and very frequently is number of angels. So friends and family, people they know, previous bosses, and so on and so forth. So there is a number of angels with very small checks who have provided that early support to the company, and that may have happened for even 1 or 2 rounds. And then we are not always, but often the first institutional investor to come in, and that's when the company's sort of governance policies, cap table, etc., gets organized. We are very happy, active collaborators, so we often co-invest, and other funds will come in. And then over a period of time, it is a fairly standard on the equity side. Over time, on the 3-4 rounds later, some of the angels might exit, so the cap table will consolidate. What is important in this space, and which we, I think, as a startup ecosystem have not really leveraged as much across the board, not just in climate, is the use of the full balance sheet. So using debt as an instrument, and venture debt is there, but venture debt, the way it is structured is a little bit quasi-equity. It's also a fund. It's a SEBI-regulated Cat 2 fund. Most AIFs today are either category 1 or 2. So they're either small very early or category 2. I think over time, as the cap tables, I would like to see a more balance sheet plus P&L approach evolve in companies that are building real businesses over a period of time. So not just equity, but also good use of debt. But again, that product is not always available in the market. So low collateral or no collateral working capital capex that can be made available for, MSMEs actually have more support today than tech startups do in that space.
Yeah, because if there is no balance sheet, collateral becomes a problem,
Right.
and if the value is something like, let's say, energy efficiency
Right.
that you're promising the next 10 years,
Right.
it's a very sort of notional.
That's true, but actually, one of the things I'm seeing is in our companies, because these are not burn-led businesses. So you actually have real revenue and over time profit and cash flows. They are able to access commercial debt, and some of these are in what could be deemed as priority sector as well. So I think somebody asked the question, what should a startup look at? I think they should get creative and look at all forms of capital, including debt. If they're in the agri space, they might be eligible for priority sector. Similarly, MSME or some of the other sectors that are now getting included. And we need more. Definitely, we need more debt capital. We need more of our commercial banks to create products. And we need industry to collaborate with them in that. So like the CGTMS scheme that was put out for MSMEs, perhaps something like that for deep tech manufacturing type startups.
Makes sense. Thank you.
Thank you. So I don't see any other questions on the tab. So I think it has been a very interesting discussion on climate tech and
on the hour.
Sorry?
We are on the hour. We're bang on time.
Yes, yeah. And so I personally learned a lot about this particular, climate tech industry and the startups, right? So thanks a lot, Miss Bansal, again for your time, and thanks to all the participants who joined us today. And we are going to put the recording of this webinar on YouTube within few days. And again, I thank you all of you on behalf of the Center for Corporate Governance and Sustainability Research at IIMA, and see you soon. Thank you.
Thank you very much.
Thank you.